Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's May 12, 2013. Markets rose yet again last week, as if you didn't already know. As I talked about in the last broadcast, though, when you get a week that's basically empty of major economic news, as last week was, the market usually keeps going in the same direction it had been headed in the week before, which in this case was up. But that's left some of last week's problems in sharper relief. Prices are now even more extended than they were the week before, and the latest move, which came on very light volume, has created a kind of warm and fuzzy glow in some quarters of the media about the inevitability of stock prices rising forever on a combination of weak growth and an accommodating Fed. No one wants to say the word Goldilocks, since the last time it was popular was in 2007, and it turned out to be a sucker trap. But the Goldilocks theory that the economy is neither too hot nor too cold, but just perfect for stocks, is gaining a lot of traction again. At the same time, some dangerous things are happening below the surface that are going to hurt the markets in the end. Credit is getting loose again at the corporate level, so loose that some well-known private equity firms are trying to sell as much of their investments as they can. Junk bonds, or high-yield bonds, are at all-time high prices and all-time low yields. Margin debt is nearly back to the 2007 peak. One of the problems with that is that it amplifies selling during downturns. Another problem that is paradoxically driving equity prices higher is the beginning of a global currency war. The G7 countries are trying very hard to pretend that Japan isn't solving its problems with a cheaper yen. They can't, because if they do, then there would be a public media fuss and an open currency war might follow. But other countries already have started to follow. In the last couple of weeks, the EU, South Korea, Vietnam, Australia, Poland, and India have all cut rates. The semi-ecstatic knee-jerk reaction is that all of this central banking must be good for stocks, since it's been good for US stock prices. But it isn't about stock prices or trying to restart a local economy. It's about protecting your currency in a world where everyone is trying to export their way out of every problem. The reaction to the first round of cuts may officially be to try to look the other way, but if the yen falls another 15 or 20%, as many believe it will, more cuts are going to follow and the pretend battle will get real. But that probably won't affect markets in the short term. However, the helium-like rise of prices on nothing more than trading momentum will. I still look for a correction to begin shortly. I'm Kevin Flynn, and thanks for listening to Avalon's Market Minute.